Good afternoon, everyone. We've got a great panel here to discuss institutionalization of mining, shareholder value, governance, and capital efficiency. Let's kick it off with, go to Matthew and Michael here. Mining stocks have surged this year, Bitcoin mining stocks that is, driven by this renewed institutional interest and this view that power infrastructure and megawatt optionality could unlock value through AI HPC use cases. I want to take a step back first and just focus on Bitcoin mining itself. Many investors may be overlooking the potential for long-term value in the pure play mining model. And Matt and Mike, both CleanSpark and American Bitcoin remain committed to expanding Bitcoin mining at scale. So maybe you could just walk us through your go-to-market strategy in mining, what differentiates your business models, and how do you plan to generate sustainable excess returns through future halving cycles, which has been, historically a tough industry.
You want me to go first?
Either or.
Okay, I'm happy to take it. So I think what history has taught us is that Bitcoin mining is really an efficiency game, and that was reflected in Irene's presentation. But aside from the hardware, the competitive advantages comes by way of scale, access to capital, fleet efficiency, uptime, and even technology stacks that kind of increase the value of Bitcoin mining. And so for a company like CleanSpark, we've kind of taken a different approach than many of our peers in that we don't sell all of our Bitcoin. We have a digital asset management desk that generates additional yield from the more than 13,000 Bitcoin that we hold. We have, I think, the industry-leading uptime of the North American public miners at about 98%. And what that's enabled us to do is to create a business with $800 million ARR at 54% margins, and to become a consistent partner with utilities. And so I think kind of a long-winded question, but the way that you maximize the value from our perspective is to identify the areas where there are inefficiencies and create efficiencies there, and then use that scale that we've generated and like Michael has at both of his companies to secure additional opportunities for land and power. Because as many of our peers have discussed today, there's I think the overwhelming majority of Bitcoin miners have now talked about either a complete pivot to HPC or a hybrid focusing primarily on HPC. And so from our perspective, to have a business with those cash flows, with those margins, it creates predictable opportunities for power contracts that I think get us in the door to expand our power and land portfolio better than most. So I think, again, apologies for the long-winded answer, but I think it's really a combination of levers that you can pull. And as we spoke about earlier this week, CleanSpark just announced an SVP of AI data centers from actually here in the region from Humane that will give us an opportunity to continue to maximize the value of our extensive portfolio of power.
On the completely echo that sentiment, but on the Bitcoin mining side, really see it as two toggles. It's your cost of energy and it's how efficient your fleet is. On the energy side, we're very confident that we are in the upper echelons of beating the average network energy price. In ERCOT in Texas, where a big footprint of our deployments are, the 24/7 rate across Texas is roughly 5.7 cents. And last year, I believe with about 8% curtailment, so curtailing the peaks during the polar vortex, during the very hot summer days, with about 8% curtailments, we were able to reduce that 5.7 cent firm 24/7 down to the low 3-cent energy rate. 3 cents is in the threes is extremely competitive for Bitcoin mining. When you look at the average electricity price across the Bitcoin network, I believe that is still north of 6 and slightly climbing. And then on the other end, on the efficiency side, we have one of the more efficient fleets as an average across our footprints. We're about 16 joules per terahash, and that's decreasing as well with obviously the future generations of machines that manufacturers like BITMAIN are releasing. And when we look at the longevity of our efficiency, when we think about the silicon, when we think about the upper limitations of Moore's law, when BITMAIN introduced their ASICs from the S9 days, the 16 nanometer, going down to the 10, the 5, and now the 3, we saw drastic upticks in efficiencies and densities on the silicon side, on the wafer side. But going beyond where we are in this current generation, I believe, unless Irene makes me eat my words, that the manufacturers are not going to jump from this 10 joules per terahash down to 1 or 2 joules per terahash. And there's a trade-off on the cost of the next generation nodes from the semiconductor, from the fabs, TSMC, Samsung. When you go to the latest generation silicon, like the 2 nanometer, you're competing against the giants, the Apples, the NVIDIAs, the defense contractors, and the density and the efficiency increase may not outweigh the increase of the actual silicon. This is a long way of saying I believe that we're at a point in the institutional stage of Bitcoin mining where we'll see nominal increases in efficiency, where we'll see a lot more longevity with the fleets that we have deployed, which is why we're actually investing more, slightly more into our facilities. There's a second toggle to this, which is a very hot topic of the convergence between Bitcoin mining and AI. And we went from more of the off-the-shelf air-cooled form factors in containers to our latest build, which is in West Texas at our site called Vega. We built what emulates more of a traditional data center form factor. We use U form factor data center racks. We're running direct-to-chip liquid cooled using the S21 Hydro XPs. Each one of our racks can cool up to 200 kilowatts, which is more than the density for NVIDIA's latest AI GPUs. We're investing more into our environments, the efficiency form factor, because we believe that increasing the longevity of these chips is more important. We're not at the cycles where we believe that the chips will be obsolete because of its efficiency, but we're more so focused on investing and extracting as much useful life out of our chips while creating the optionality as a phase 2 in the facilities, in the CapEx that we invest on the hut side for a potential transition into the next generation of AI GPUs.
That was great, and I want to talk more about the efficiency and going through future halvings in a minute. But Irene, BITMAIN has been described as sort of the NVIDIA of the Bitcoin mining ASIC hardware market, right? Market research shows you have pretty significant shares, 75% or so, and you've held that for quite a long time. Many investors view you as the true picks and shovels play in this industry, and you capture potentially more value than the miners themselves. You see a lot of public miners now pivoting to AI. I'm curious, Irene, where's the growth coming from on the network hash rate side? And how is BITMAIN adapting to this with some of your largest customers, no longer committed to expanding to Bitcoin?
That's a good question. So I think you are exactly capture this transformation of the public miners pivoting to AI and HPC. From our perspective, from our data, we see it in bifurcations. And first of all, there's a lot of public miners. They are diversifying their portfolio into AI and HPC, and they have a really good market cap right now, doubled or tripled. We're very excited for them. And at the meantime, the private miners are stepping up to fill the gaps this year. We see a lot of demands from this year who are looking for either expand their own mining capacity or they want to just purchasing the unracking miners and the one-way solutions, adding into their portfolio so they can ensure to catch up the peak time of this cycle. From BITMAIN's perspective, also the demand for upgrading their old mining fleets remains strong. So our role is to helping our clients to make the transition smoothly. So we are responding to the market very quickly to ensure that all of our solutions can be diversified as well to meet demand from different clients.
Thanks. And going back to Michael's point here on efficiency, Matt and Michael, the trend in average hash price has been decisively downward through each halving cycle. And historically, as you guys were talking about just prior, miners have responded by continually upgrading their fleets for fleet efficiency. And that's a highly capital-intensive approach, and that increases reliance on third-party manufacturers like BITMAIN. I'm curious if that is going to be a viable approach going through future halving cycles. There's been some questioning around that and in the industry, and how sustainable this continual CapEx refresh is every 3 years. So I want to ask, how are you thinking about this going forward, driving hash costs lower? Is there anything you can do on the power side to sort of, reduce or optimize your power costs to get hash costs down? And, how are you thinking about fleet efficiency, going forward?
That's an interesting question. Much like Michael, we're at 16 joules a terahash. We have 50 exahash operational now, about 1.03 gigawatts of power. We have another 6 exahash of the new S21 XP immersion machines that are being deployed as we speak. So we've historically, CleanSpark has operated counter-cyclically, and so our fleet cost is lower than most in our industry. Now, the way that we really look to optimize that, and I think the announcement this week plays into that, is that by creating additional revenue streams, obviously HPC AI will be one, but the durable revenue generated from our digital asset management desk makes a difference. With regard to the efficiency of our fleet, I think the big differentiator comes down, and as Michael kind of pointed out, to power cost. And we went to an industry event in North Georgia for another mining manufacturer. They invited us to go look. So we visited with them as they were doing their product release, but the CEO of the local utility grabbed myself and a couple of my colleagues and wanted to go have a lunch meeting afterwards. And the purpose for that meeting was the fear that's created by all of these interruptible loads, that the curtailable, the callable loads that really benefit the grid going to 99 and 5/9 uptime creates a challenge. And so what we found is that by being an interruptible load, and that is we'll give back about 120 hours over the course of a year, it can dramatically reduce our energy cost. And so what we've done, historically, we were managing to a power price. We would curtail at a certain threshold. But with the volatility in Bitcoin mining and the value we generate from our digital asset management desk, we're now managing our fleet to a margin. So as I mentioned in my earlier comments, we're at about an $800 million ARR as of the last quarter with 54% margins, not necessarily focusing on the 3 or 4 or 5 on the kilowatt hour, but rather maximizing the uptime and efficiency during the periods of time that the power makes the most sense. So I think when you pair all that together, it creates a different approach than simply plugging in a box and walking away. So with our active strategy and the way that we've deployed across multiple different types of infrastructure, we have, I believe you've had an opportunity to visit some of our sites. We have a 250 megawatt air-cooled site. We have, previously full tier 3 data centers that we tore up the agreements and fired the customers and switched them back to Bitcoin mining, and we've done full-scale immersion there. So we have a lot of geographic flexibility. So I think the next iteration, or the next, I guess the way CleanSpark evolves and maintains a competitive foothold in Bitcoin mining is to identify areas where latency is less of a concern, there's less demand for a hyperscaler, but that also translates to less expensive power. So I think what you'll see is Bitcoin mining fleets migrate to areas like what Michael's talking about on the ERCOT network, and focus more of the major metropolitan megawatts to higher value compute.
Yeah, let's completely agree with that. On the hash price question, over time, when you look at the hash price charts, we've seen volatility really come in across the board on not just hash price, but Bitcoin as well. A couple cycles ago, the implied vol on Bitcoin itself was triple digits in the hundreds. Last cycle, that came down to 70, 80, which is still extremely high. And now we've seen volatility compress on Bitcoin down to about the 40s, where this type of double-digit percentage drop cycle over cycle means that it's scaling. There's a lot more capital coming in. There's a lot more depth coming in. We're seeing a lot more institutional capital coming in. But how this relates to on the hash price is there were times where we saw a dislocation and a jump in the underlying Bitcoin price relative to the Bitcoin mining network and the difficulty, so to speak, where at times you will see extremely advantaged economics for miners while the manufacturers and the silicone and the supply catches up. But now that we are at about 1,000 exahash as a total mining footprint, that severely reduces the volatility, and we can assume and we can underwrite to a more appropriate, stable range. And that is why we focus on the economics of being some of the lowest cost producers, having access to some of the lowest cost energy, as well as maintaining a efficient fleet and investing in the longevity of being able to extract as much life and use out of the fleet. To Matt's point, as a Bitcoin miner, the metric shouldn't be, especially for a public company, to grow at all costs, but it's to be very thoughtful in the metrics as to the actual profitability and how you underwrite the return profile and the IRR, where the consideration is hash price against the cost of the acquisition of the latest generation, where we foresee the rate of advancements are, as well as our operating costs. And I think when you add all this together, Bitcoin mining as a business, when operated efficiently and effectively, allows a constant stream into acquiring discounted Bitcoins, significantly discounted Bitcoins off the spot price, a asset class and underlying that outperforms everything that we know. Over the last 10 years, Bitcoin itself has appreciated at about a 60% average. So in itself, when you're holding Bitcoin, it's a 60% year-over-year increase. Bitcoin mining just further compounds that by being able to mine it for, in some cases, 50 cents on the dollar.
All right, let's say it's 2032 though, just on this question one more time. You know, we're 2 more halvings away from that, right? And is grid power still viable for a Bitcoin miner? Or, you know, are we going to go to this kind of industry where maybe you're, you know, mining, you know, with sort of off-grid or assets or so forth, power assets?
So I think that the interruptible nature of a Bitcoin mining load is actually invaluable for a utility. I think it's favored, and so that's why we get preferential treatment on some of the energy prices to be willing to allow that power to be called back. So there's certainly a use case for behind-the-meter generation, co-locating on stranded power assets. I mean, the evolution of the industry is such that, I mean, gosh, Microsoft just announced how many $1 billion in small modular reactors to support some of their campuses, and I think we're going to see the acceleration of those types of energy generation assets. The challenge is that you can build the generation much quicker than you can build transmission and distribution. So I think there will always be opportunities for Bitcoin miners to energize those megawatts much quicker. You know, last kind of quick point on that, we have 100 megawatts in Cheyenne, Wyoming. And we were bidding for those megawatts against Microsoft. Now, certainly the utility didn't select CleanSpark because we had a stronger balance sheet, but the challenge was that Microsoft was contemplating those megawatts for an Azure campus, which is a 36 to 48 month run rate, and the power's available now. So when you look at the economic value to the utility, to be able to monetize megawatts more rapidly, it plays into the strategy that we can lock up those megawatts and deploy the new technologies like what Irene showed earlier. I mean, it's almost plug and play. That facility in Cheyenne, we went from scraping the ground to 100 megawatts of immersion cooled infrastructure inside of 6 months. So I think that all kind of plays a factor, but I think it's a really invaluable load for the grids to have to allow the flexibility.
Okay. I want to shift over to the AI HPC area, and maybe Irene, we can start with you. Is BITMAIN developing or adapting its hardware to serve, the emerging AI market alongside of Bitcoin mining? And maybe can you share any perspective, if you're evaluating this opportunity or making any strategic moves here?
Yeah, we see the opportunity, but instead of providing a server to the market, we focusing on infrastructure side. We think, having an infrastructure can bridging the Bitcoin mining and AI infrastructure actually creates a tremendous value to all of our existing customer, the current community and ecosystem, comparing to, to get into AI server business.
Matt, Michael, the market, obviously we've all know this, we've been hearing it all day today, has come to appreciate Bitcoin miners' control of large-scale energy infrastructure assets. How do you view this convergence of energy, AI, Bitcoin mining? What's the strategy for capitalizing on this overlap as the market dynamics evolve?
I think both worlds of Bitcoin mining and AI can coexist, and they don't fully overlap. Matt touched on a couple of these points. ERCOT is a region where they've had a lot of experience with Bitcoin miners at scale and have seen the benefits of just what it means to be an agile, curtailable load, and the difference between the Bitcoin miners and AI data centers that require full redundancy and full uptime. So on that last point, I think that there will always be room on the grid, and even more so, more strategically and more efficiently for the grid as they recognize the benefits of the curtailable aspects of Bitcoin mining. But when you look at power, not every electron is the same. Not every electron can be fungible for Bitcoin mining or for AI. The power itself can, but there are other parameters of site selection that rule out a lot of sites that would be great for Bitcoin mining, but not so much for AI or the next generation of data centers. And I don't want to use the word AI data centers too loosely. There's a greater subset of the data center market that is not just AI, but mostly what I believe what we'll see on the data center side is there will still be demand that is mostly latency constrained. Latency for most tier 1 hyperscaler data centers, when they're running inference, they still have an upper ceiling of about 100 milliseconds, which translates to being sub 120 miles or so from a AZ or a tier 1 hub. We've seen recently this surge of power and demand where that parameter set has opened up more so for training applications, but as we move more into inference, I believe that there will be that constraint on location, to Matt's point, and that latency requirement, as well as some sites you have access to energy today, not enough land for the data centers, no redundancy and fiber. Bitcoin mining is extremely agnostic, it's extremely agile, and Bitcoin mining can come in today and utilize that power today. So Bitcoin mining solves for, and oftentimes in cases, a time mismatch of that broader parameter set and infrastructure to be built out for potential transition in the future to data centers.
Matt, you have made some big announcements recently around this, and as you became, the new CEO, so maybe you can talk on this as well. How are you seeing, this convergence, and where's CleanSpark's focus here?
So, one of the things that we focus on a lot, and we've discussed it here today, is the capital structure for Bitcoin mining. And the challenge is that unless a Bitcoin miner has an adjacent company that's willing to extend financing, it's a huge CapEx lift up front. The difference is, we built out the Cheyenne site as an example, less than $1 million a megawatt, inside of 6 months, full-scale immersion, and we had the ability to deploy on a Starlink because the fiber backbone wasn't even there yet. And so that gives you some tremendous flexibility and speed to market. To do that same build for an AI data center is about 10 times, so it's about $10 million a megawatt. The difference is that depending on the customer, who becomes your tenant in that powered shell, now you have access, like we've seen with some of the other publicly traded miners, you get a Google that backstops your financing. Now all of a sudden your cost of capital goes way down, and you can generate, you can make the investment comparable to what you'd be spending on a Bitcoin mining facility from a cash cost, but finance the balance and get returns that are 8 to 10 times greater the ROI on the same infrastructure. So, what we've done on our team, we started out when we were in air cooling. When we started Bitcoin mining, we hired a guy from Brazil that kind of led the charge for us, had mined more than 50,000 Bitcoin, taught us what were the best practices in that space. When we evolved to immersion cooling, kind of the preeminent expert in immersion cooling specific to Bitcoin mining in the States was a company called TMG. And we stole their founder, Taylor Monig, to head up our immersion mining operations. We've duplicated that by hiring the right people first. And so our hire this week is, it's important because it's 4 decades of global data center development experience. It's, having Jensen Huang on speed dial on your phone. It's having the customer base of people that you've deployed for in the past that are looking for those same type opportunities and returns. And really the appeal for Jeff to join a company like CleanSpark is what we talked about in the beginning, and that is Bitcoin miners have done a masterful job of securing land and power. And what we've found is, our first location is adjacent to the airport, in the busiest airport in the world in Atlanta, Georgia. And those megawatts were not high value 5 years ago. Now the low latency in the second largest data-driven hub in North America, the value of that is an order of magnitude greater to repurpose those megawatts for high-performance compute and reallocate the mining resources elsewhere.
There's like 6 gigawatts, roughly, I think, in the 10 miners I cover that are in the pipeline for the next 2 years. Would you guys, this is a quick question for both of for you, do you think that all gets leased out by the end of 27, or do you think we fall short of that?
Energization schedules, large load studies, everything that goes on with ERCOT is never. I don't think the network cares about the timelines of publicly traded companies, and there are blackout periods. So if you get an approval and you build the substation and you fall 1 day short or 2 days short into the fire season in ERCOT, then there's an embargo for energization for a number of months. So I think the real value we're seeing is energized power today. That is a premium, because so many of the discussions that you hear, especially from other publicly traded miners, are about multi-gigawatt pipelines that are slated for development or that are in consideration on the network. I think actually having energized megawatts, like I said, we have just over a gigawatt now, but we have line of sight on an additional 1.7. So having kind of staggered deployment schedules, I think being conservative in our forecast has always served us well. We've always been conservative with our guidance on hash rate, on revenue, on everything else. And so we've developed some credibility. And so I think if you look historically at the way that both of our companies have performed. It hasn't been high-flying, forward-looking guidance that you have to miss and revise. It's that you hit and raise. And so if that, remaining consistent, I think that translates very well to the expectations from the hyperscalers. I don't know that the energized pipeline that we're talking about hits the timelines.
It's the big investor question everyone wants to know. So.
But also, I don't think as much of that footprint is going to transition from Bitcoin mining, online Bitcoin mining data centers today to fully AI. To the point that we both touched on earlier, is a Bitcoin mining operation is a curtailable and agile load, whereas an AI data center is expected to be on full redundancy, especially in places like Texas, where a lot of miners have their footprint. A lot of the sites are on co-ops where we're subject to 4CP, 7CP, 12CP. The load studies were placed in a way where they expect us to be a curtailable and agile load. And there are ways to service around this with Bloom fuel cells and whatnot, but in some cases, it is a new study to go from a curtailable load to a firm AI data center load.
Okay. I want to end on this one, maybe a fun one, on just your high-level views and where we stand in the current bull cycle. So all three of you. The past 3 cycles have averaged just over, if we're looking at trough to peak, 31 months. And the last 2 actually were, I think, last longer, like closer to 35. And so the current cycle, we just passed that duration like a couple weeks ago. And I'm curious, do you think, given sort of this evolving market with the institutional factors, you have some very positive regulatory tailwinds with the Trump organization and so forth, do you believe this cycle can run longer than the prior ones, or are we going to be in for the same, sort of what we've seen with Bitcoin historically and volatility and, bear market potential? So start with you. Yeah.
I always love when I see an investment deck, especially for funds, and they show their past performance is like up 70% year over year. And then there's always that disclaimer, past performance is not an indication of future results. And I think it's the same to be said about Bitcoin. And there's this notion of the cycle where everyone expects Bitcoin to do X, Y, Z after some time period during the cycle. I think what is more tangible or what's more factual and a better indicator is look at the inflows of capital that's coming into Bitcoin. Look at IBIT, BlackRock's ETF. Less than 2 years, it's already over 100 billion. BlackRock's gold ETF over 20 years is only a mere fraction of that. When you look at the inflows of IBIT, I think it averages somewhere around $200 to $300 million a day on average. That's a lot of institutional capital that's never been seen before in previous cycles coming into Bitcoin. And then you have supply effects. You have Saylor, you have Strategy buying a ton of Bitcoin, controlling, I don't know, 600, 700,000 Bitcoin as of last. A lot of treasury companies that are emerging. You have this inverse dynamic of increasing inflows of capital, and a lot of it institutional now, and this diminishing supply that's being taken out of the float. So I think that regardless of what happens based on this notion and expectation of the Bitcoin cycles, we're moving into a new era of more sustainability, a more sustained increase of adoption, where there's a lot more institutional capital and lower volatility.
Okay, so Mike's on we're in a new era. This time's different. How about you, Irene? Is this time different?
Yeah, most of the people around me are a cycle believer, but I feel with the institutional holders, the holding of Bitcoin definitely changed the shape of the cycle. And after the BTC Treasury strategy and government's security reserve and the holding of institutional investors, the foundation of this cycle is stronger than ever.
All right, this time's different. How about you, Matt?
I think this cycle's broken. 450 Bitcoin a day, that's it. And And to Michael's point, IBIT has amassed $100 billion in investment in this pristine asset class that is hard capped at 21 million. So, I think the adoption, the credibility, the financial products, the derivative instruments that are now being written. I mean, now we're hearing that, even JP Morgan and Morgan Stanley their advisors are recommending their clients hold a certain percentage of their net worth in Bitcoin. So, the magic internet money phase is long gone, and I think the credibility of the asset class has created a complete paradigm shift, and I think the 4-year cycles are broken for good.
All right. Thank you, everyone. Appreciate it.